Welcome to On Investors' Minds. I'm Kerry Craig, a global market strategist here at JP Morgan Asset Management. Thank you for giving us a few minutes of your time to hear about what's on investors' minds and how that fits in with current views on asset allocation. It's the 4th of August and we're recording this in Melbourne, Australia. Joining me today on the podcast is Fiona Harris. Fiona is the head of US equity investment specialist internationally and is coming up on 30 years within JP Morgan Asset Management. This is phenomenal as it really gives some context to today's conversation around the US equity market, having obviously many lived experiences through market uncertainty, volatility, as well as prior periods of technological change. So Fiona, welcome. Thank you for your time today. Delighted to be here and delighted to be in Melbourne. Yeah, it's putting on a good show in the winter weather with a bit of sunshine for you today. So let's dive into the questions. It's really fantastic to have you here right now because obviously the US second quarter earnings season is underway. We're a little over halfway through that earnings season. Headline numbers for earnings growth look very strong, but the market reaction has been a little bit more choppy in terms of what we're seeing. What are your key takeaways from the second quarter earnings season, and how is that earnings outlook shaping up for the rest of this year and into next year as well?
Yeah, it's a great question. And particularly when you talk to companies, it's really important to hear the intent of what they're thinking about for margins, for CapEx, spending cycles, hirings, and everything else. But when you look at the surface, and so far, 86% of those companies that have reported have beaten expectations. And this is a really high number, right? And so that's the broadest beat we've seen in 5 years. So one, it's good. It's a really good earnings season. And so that's a key takeaway. Right now, it looks like we're going to have earnings about 45% year over year. That's earnings per share. Now, there's things we have to adjust for. The hyperscalers had a lot of investment gains. If we take them out, it's about 33%. Let's put that into perspective because these are big numbers. Over the long term, the S&P average earnings per year is around 7%. Okay? So we're in this hyperscaler, super cycle. And I think that's really, really important in terms of where we are. Long term, we think earnings growth for the US is good for this year. It's good for the next year. But long term, let's take a step back and go more in terms of the long-term averages, right? That's 7-8% type time frame. So I think the market's trying to weigh, is this peak earnings? Is this as good as it gets? And for that, we'll just have to wait and see. But right now, companies are exceeding expectations. They're raising guidance. They're being rewarded for that. And I think, that's where we're sitting at right now.
Yeah, that's that number about 86% of companies beating. I mean, most companies beat because the messaging they put out. But I think on average, that number is closer to 75%. So they're doing much better than average. And that earnings surprise has also been extremely high this time round compared to averages. So it is a little bit unusual with the market reaction. I know the S&P 500 is nearing back to all-time highs at the close of yesterday, but the question that markets and investors are really coming back to is obviously AI, the hyperscalers you mentioned, that CapEx number. There's this big difference between how we're thinking about markets reacting to revenues and thinking about earnings as well, because they're looking for, is this being monetized and are they seeing the gains from this? So as that hyperscaler CapEx number keeps rising, even as free cash flows starting to look like they're turning negative, for me, it's the market really trying to price in whether this CapEx is going to be rewarded and really who's going to be the big beneficiary of this. And it may not be those companies that are there today. Is it the ones that are spending the money? Is it the ones that are going to be the adopters of this technology? But for the here and now, it's all about how far can this CapEx story continue to go and continue to climb. So from the US equity investment team, how are they thinking about this capital investment cycle and where it goes from here?
Yeah, and I think like the earnings number, these are big numbers we're dealing with, right? Everything's really big right now. And it's rising, right? If you look at CapEx expectations for the hyperscalers in June 25, looking forward for 26, that figure as of now has risen over 100%. If you're looking for CapEx expectations for those same companies for 27, it's risen 150%. And it looks like we'll probably hit $1 trillion by 28. So it's an awfully big number. But underneath the surface, and I think this is what the market's trying to decipher, is when it comes to that money being spent, it's no longer coming all from cash flows. And so for a lot of these companies, cash flows have turned negative or about to turn negative. And if you look at debt issuance, for US investment grade tech companies, that's about 30% of debt issuance right now for investment grade. That's a record high, but not a good high, right? When we think about the other numbers. So it's definitely something to watch in a period of time where we do believe interest rates will be higher over the next 6 to 9, 12 months, whatever that window is, and you're issuing more debt to fund this growth cycle. That usually is how we see other cycles come apart a little bit. So there is some angst in this marketplace in terms of, yes, you've got great earnings growth, but fueling some of that is CapEx spend that's no longer coming from cash flows as it did previously. So that's one area that's definitely one to watch in terms of where it is. The other one, as you talked about, is absolutely right. This timeline for a return on investment, there is a great deal of uncertainty there. And the market, again, when you're spending big numbers, they do want to see that return. Now, the good news is we're seeing more use cases. We're hearing from more and more companies across more and more industries about the use of AI. We're hearing it more and more and using it every day in JP Morgan. We're at that critical juncture of actual usage coming through. I take a step back. You did talk about me being at the firm for 30 years. I often joke that AI sometimes feel like productivity gains that you just don't notice. When I joined the industry over 30 years ago, the most important job was putting paper in the fax machine. Why? Because earnings and data came through on fax. It was really critical that there was paper there. Today, people laugh because today you've got, an analysis of an earnings announcement as it's happening so quickly, and that information is, transferred around the globe in seconds versus the paper that we had to put in a fax machine. And people talk about having speed readers so they could get through the analysis really, really quickly. You don't notice on a day-by-day basis those productivity gains as you switch from one technology to the other, but they do become evident over time. And one of your other comments I think is really critical is we know new companies will be developed. We know there'll be newer technologies on top of this because the one constant in technology is disruption. And so having that deep bench of research analysts is critical at the end of the day, right? So that you can have that lens across US equities, you can have it across global equities, you can see what's happening on the ground, but you can also see what's coming next that's going to disrupt it. So yes, while the earnings are good as we talked about, it looks really, really good, there is some concerns on the interest rate side and because of the amount of debt that we're seeing. And so I think the market is being cautious, it's asking the right questions. We're seeing some volatility in stocks because of that. And that's not a bad thing at the end of the day. That companies really do think about that intent in terms of where that cash is coming from to actually fund that growth rate, and does it make sense to have that level of debt for that growth rate. And so I think we're still at that point, that juncture where the market is assessing that and rewarding companies for good behaviors, but actually questioning those in terms of behaviors that they don't understand yet.
Yeah, it's been remarkable to watch the companies that have beaten on earnings but missed on revenues this season be the ones that are really punished. So, the day after their report, they're down 3%. Compare that to the companies that are missing on both earnings and revenues, they're only down about 1.8%. So that focus on how you actually monetize this, thinking about the adoption rates and also the increased competition across some of these models from both within the US and across the market. So some of the Chinese models that are coming out are remarkably sophisticated, but it still feels like we're in this pay-to-play kind of investment cycle where companies have to be front and center. They're trying to build big platforms to be there, and if using debt as part of that, obviously that does increase leverage and bring in some of those concerns. But I think it's still at a case where everyone I speak to within JP Morgan and within our own team is still very positive about being relatively early in this AI cycle, and so that capital investment has a long way to go. I wonder if you could just, and it just occurred to me there, talk about a little bit about how the US equity investment team may use AI within their own processes for investment. You talk about some of the changes, the sort of incremental adoption that's coming through. We think about it from, I guess, how we use it in our day-to-day jobs, but on the investment side, it must be a good addition to thinking about how you can invest in companies.
Yeah, it is. And I think one of the critical junctures is the amount of information out there. and getting your hands on that information, right? So we're doing a lot of things. One, it's about with all our jobs day to day, where can you use this the best to your advantage instead of searching for answers? You can have that AI tool search for you and come back while you're doing something else. So productivity increases. But also thinking about the amount of information we've had, right? So there's two ways to look at this. We've got over 30 years of research data into US companies, right, from our research analysts that we can actually look through to see in terms of examples and history and everything else, which is really great to have. And we also can think about how we might do it in terms of using that information in terms of what we're doing day to day. So one of the things we ask our research analysts to do is what we call predetermined game plans. Set out your thesis for a company, but also think about it not only in terms of the milestones for what might work, but also the things that might work against you while your thesis might not come to fruition. And then what we can actually do now with the AI analysis is actually look at thesis drift, right? Our analysts are great and prolific writers. They send a huge amount of stuff through to us, both on emails and in meetings, and actually look through those emails to see if they're starting to drift from that thesis, and so that we can capture that sooner. And that runs in the background. So it's not changing how we're doing things, it's making us more efficient in terms of all that information that we have and using it more and more. And maybe the next step then is to look in the marketplace and say, hey, if you're looking about this, your thesis relative to peers, competitors, is there a change out there in that landscape? So it's taking the volume of information we have today and really condensing it very, very quickly that you have that lens. And I don't know about you, but my memory is terrible. So any tool that helps with that in terms of information is fantastic at the end of the day, right? That it actually can go out there and find this information for you and bring it back to you instead of you searching. And I think that's actually a great way to think about it. But there's so many use cases. That's just one example, right? But if you think about the efficiencies it can bring day to day, it's so helpful.
Yeah, it just builds on, I guess, that depth of research that JP Morgan offer across those equity analysts and what they're doing in terms of feeding into the portfolios of our investors. I want to move away from hyperscalers and AI. I know it's all-encompassing at the moment. But when we're looking at the market overall, obviously we know that's a very high weight within the market cap. We look at the AI and AI-adjacent names, but we're looking across the US equity landscape. There's a lot of other companies out there. What is the growth looking like in the rest of that market? I feel like we've been talking about the broadening out of earnings growth for quite a few quarters now. It's slowly materializing, but perhaps not as fast as we had anticipated. What are we seeing in terms of the non-AI part of the US equity market?
Oh gosh, I'm right there with you talking about the broadening out, probably even talking about it from last year. But the difference being that the earnings revisions we saw last year was that narrow cohort of AI stocks. And I think, when we look to today and overall sense of things, we're looking at earnings growth that, again, is double-digit earnings growth. And we should start to see, hopefully, that broadening out, sooner rather than later at this stage. And I think underneath the surface, I know we've been talking about the markets and everything else, but, we build portfolios on fundamental analysis. So it's very much stock by stock rather than thinking about it from a sector or macro perspective. And so when we look underneath that surface of the marketplace, there is pockets of the market that have been left behind, right? When you look at things like industrials, the AI-related names within industrials have done very, very well. But there's a lot of names within industrials that, have still, great earnings, but not being rewarded. Now, industrials, like most parts of the US market, had a rolling recession. But when we look at these companies coming through on the other side, there's lots of good growth there in terms of businesses that are just not being looked at because they're not AI trades. We can also think of that in relation to some stocks within the healthcare space or financials, right? You saw a bid for the investment banks, but the rest of the banks haven't really seen at the same extent of that rally. They've had great earnings. It was problematic in Q1, much better earnings, good beats in Q2. And it's only starting to see that come to the surface in the last week or so in terms of financials more broadly. So yeah, outside of AI, there's a lot of excitement. in terms of good companies that you can invest in. But I also think if we take a step back to AI, and I know you wanted to take away from it, one of the concerns is that overall AI trade and the correlations in people's portfolios, it's very, very high. Values outperforming growth year to date, but it's not financials driven, which is the biggest part of a value index. It's more the AI related names in memory and hard disk drive that have been in value. So I would say when you're looking under the surface, when you're looking for funds or stocks to invest in, I would say and caution really be good in terms of correlations and diversification. I think right now is the time to think about risk management and being diversified and make sure you have true diversification in your portfolios.
I mean, yeah, wise words to live by at the moment, especially across asset classes. We think about stock bond correlations and also within the rising concentration, not just in the US, but, in most like emerging markets, we've seen the rise in Korea and Taiwan and the weights of, a handful of companies with that indice as well. The other thing, again, trying to move away from tech, but it's very hard. It's something that comes up a little more, and I think is being a little bit overlooked, is obviously what we're seeing in margins. So when we look at the index overall for the S&P 500, margins have been expanding because what we've seen within the AI and adjacent names, so tech lifting those margins, but there's lots of cost pressures out there. One of the biggest debates is around where inflation's going. We've had a bit of disinflation in the US, but obviously we've seen re-escalation in the Middle East. Energy prices go back up. There's could be wage pressure in the US. The labor market is still relatively tight. We've got tariffs that are now being built back up in terms of what the US companies have to pay for importing goods. There's concerns around power and power generation, as well as just broader energy. On the non-AI part of the market, those cost pressures, are they going to start to lead to a margin squeeze, or are you any concern around margins being compressed in the market in the US from these very high levels?
Yeah, and I think you're absolutely right. Margins, I think right now around 14% in the US. This is, if you chart this over the long term, really since that tech boom period and productivity increases, we've seen margins really start to trend upwards. So this is a decades trend rather than a current trend in terms of quarters, right? So long-term margins have been driving up to the right. In terms of where you can go from here, I think margins are really, really good at 14%. There is room for them to come down a little bit, but we don't expect them to be compressed to zero, right? We think the economy is growing well. That should be supportive of this overall market. Earnings growth looks good long-term, though slower growth than we're seeing today. So I think we're comfortable with margins. But I think the one thing you did talk about, if we look at this market today, there is some inflation risk, right? The longer oil prices stay higher, that is some concern. If we took a step back and you told us at the start of the year that there would be this issue in the Strait and where would oil prices we'd expect them to be, we'd expect them to be $150 a barrel, right? Today, we're somewhere between 80 and 100, depending on which week it is and what the news looks like. So we're not near that $150 a barrel. You may say that's success. Well, it's success of a different kind because we started the year with Brent around $6 a barrel. It's still more expensive today. That's an awfully big leap, right? And so there is a cost to businesses. There's a cost to individuals. And I think the longer oil prices stay above that $60 a barrel, you have some real concerns about inflation. And of course, inflation concerns beget interest rate concerns. And we started this talking about investment grade debt issuance, right? And higher interest rates can be problematic for longer duration growth assets. And so when you think about the risks in the marketplace, I think, yeah, the inflation, the interest rate risk is probably the biggest risk out there, more so than anything else. So I think margins are good. There is some concern about rising pressures, though, and I think that affects things like inflation and then interest rates from here on out. So I think, yeah, you'll definitely feel some cost pressures as long as oil prices stay higher from where we are today.
Yeah, certainly the view around, equities being an inflation hedge to a degree is true. I think that the shift in way we think about, especially the big longer duration growth names in the market being a little more sensitive to where yields go and the pricing around risk-free rates is something to bear in mind, and a question that comes up a lot. The bigger question that's come up more often in the last few months has been the market momentum. It does seem like the things that are winning keep winning, the things that aren't winning keep losing, as it were. And that can be a bit of a challenge when we think about fundamental investment based on analysis of companies based on the quality, and that being challenged to a degree. Is that momentum starting to fade? Do you think quality is going to come back as an overriding driver of thinking about investments in the US market?
Can I touch wood? Can I knock on the wood? Yeah, we've just come out of the second quarter, and beta had the best quarter in terms of high beta momentum that we've seen in a long, long time. What we're trying to decipher right now in terms of these markets, and the market will decide it for us, is that, again, that trade has now been put aside to a certain extent, and that was the best ever. Is this a pause or a fresh higher? And it's hard to know, because you're right. A lot of this has been about the picks and shovels regards to AI. And we've had a period of time where we've moved from the Magnificent Seven to the hyperscalers, to the semiconductor stocks, to the memory names, the next leg up in terms of this AI trade. And so that's, again, when you're looking at this marketplace, you're saying, well, it's really, really hard when you manage diversified portfolios and you think about risk management. You can't have all your eggs in the one basket. And so it's been hard for active managers to navigate around this in terms of a market that's very focused on one aspect, and a market that rewards highest risk. When we look at the US equity market over the long term, there is certain trends that we do see. Long term, it is a high quality market. So quality tends to outperform over the long term. And even over time, when you have a US-led recession, the US typically outperforms other markets because that quality aspect. I think when we look back over time and over history, these cycles tend to change dynamics very, very quickly in terms of you get pockets of higher beta, higher momentum doing exceptionally well, and then you get quality coming back into focus. It's just a question of when, not if. And I think that's what you have to think about over the long term. You very much would prefer to be investing in quality names. They tend to hold up over the long term as a long-term investor, rather than trying to chase momentum and beta at this stage in this market. So when you think and you put on your risk management hat, I think that's where you have to think about it in terms of investing with good companies, good growth rates, not overpaying for that earnings, and making sure these companies have good balance sheets and they're not over encumbered with a huge amount of leverage. And so I think they're the basic in terms of investing over the long term, but you go through these cycles, and right now it's a super cycle to the extent we've never seen before.
I mean, we would agree. I think when we look at it, globally at equities, we see the US market, it does represent high quality. The earnings growth there is still very strong compared to other developed markets, even as much as we look towards Europe or Japan, or even here in Australia. So you do sort of lean towards the US as well because of that quality bias that it has and the earnings strength that's coming through. Maybe one last question for you, Fiona. A little challenging because we have many different strategies towards the US equity market, but are there pockets that you are seeing or coming from the investment side right now that look mispriced? Either direction, the things are looking too lofty in terms of valuations and not really justified based on the earnings, or there's things that are just too good to pass up. You talked about some of the non-AI industrial basket there, some of the financials. When you think about diversifying those investments across the equity landscape in the US, are there particular areas you're focusing on?
Yeah, and I think you've already hit on it. Quality companies have been cast aside. You got good companies with good growth rates. They're not the best growth rates. They're not the highest growth rates, but they're good growth rates. Blue chip stocks at the end of the day. And I think there's a lot of that market that just has been ignored to a huge extent that looks attractive. And because they're not AI or AI adjacent, they've been cast aside. And so I think that's one area that we're looking at, and particularly those names that have been, to a certain extent, have come under pressure because actually, instead of being an AI winner, the market's determined they're going to be an AI loser. And that for us is, again, dig through it, meet with companies, meet with the clients of these companies to really determine, are they going to lose market share? Are they going to lose earnings power? Are they going to go out of business in the next few years? or is this an actual opportunity to buy a great company that's just been beaten down and cast aside by the market? And so I think having a deep bench of research analysts is really important to, dig through this. For a lot of our portfolio managers, they're talking about this feels like COVID all over again, right? AI is impacting every company to a positive or a negative degree. Having a deep bench of research analysts where you can go out there and kick the tires and meet with the companies themselves, but also meet with the suppliers to really determine the fundamentals, that's critical at the end of the day. So I'd say right now is leaning into some of those quality names, including those that the marketplace has decided will be an AI loser, where we have a differentiated view.
Great. Thank you so much, Fiona, for your time today. There's some really good lessons there. I think obviously time horizon matters hugely. We get sucked into this kind of near-term view of the market and having that historical context around the cycles we go through. And what does feel like, a prolonged cycle. We're not talking about a recession. We're thinking good earnings growth. We see valuations that aren't challenging across the board in the US equity market. And so this cycle will continue to go for a little bit longer. But you can't beat bottom-up fundamental research when it comes to thinking about finding the opportunities in the market there and ensuring you're diversified across the full landscape, as much as we tend to focus on a rather narrow set of AI-related companies out there. Thank you for listening today. I hope you enjoyed this podcast. Please do share it with your colleagues or consider subscribing for future episodes. Fiona, again, thank you so much for your time today.
My pleasure.
This content is a general communication being provided for informational purposes only. It is educational in nature and not designed to be taken as advice or a recommendation for any specific investment product, strategy, plan, feature, or other purpose in any jurisdiction, nor is it a commitment from JP Morgan Asset Management or any of its subsidiaries to participate in any of the transactions mentioned herein. Any examples used are generic, hypothetical, and for illustration purposes only. This material does not contain sufficient information to support an investment decision, and it should not be relied upon by you in evaluating the merits of investing in any securities or products. In addition, users should make an independent assessment of the legal, regulatory, tax, credit, and accounting implications and determine, together with their own financial professional, if any investment mentioned herein is believed to be appropriate to their personal goals. Investors should ensure that they obtain all available relevant information before making any investment. Any forecasts, figures, opinions, or investment techniques and strategies set out are for information purposes only based on certain assumptions and current market conditions, and are subject to change without prior notice. All information presented herein is considered to be accurate at the time of production, but no warranty of accuracy is given and no liability in respect of any error or omission is accepted. It should be noted that investment involves risks. The value of investments and the income from them may fluctuate in accordance with market conditions and taxation agreements, and investors may not get back the full amount invested. Both past performance and yields are not reliable indicators of current and future results. JP Morgan Asset Management is the brand for the asset management business of JP Morgan Chase & Company and its affiliates worldwide.